Rohr here with an early morning update on Monday, June 23rd, 2014. It's currently 7:15 a.m. U.S. Central Time. And while this is going to be a general update, it's also going to be rather concise because so much is conforming to the previous expectations for various markets, tendencies, and technical levels, and the market psychology. And the first thing we'll note on the macro view is that, of course, there was not much data out on Friday, and yet the friendly bank environment that spilled over from what Janet Yellen and the FOMC had to say on Wednesday kept the equities pretty firm. And this morning, we see this in the currencies as well, more country influences. And that's because the advanced PMIs that came out so far this morning showed positive, somewhat above expectations readings for Japan and China, whereas Germany was a bit soft and France was quite weak. And we're looking into the U.S. advanced PMIs a bit later this morning, along with existing home sales. Of course, that's the prelude to Tuesday's new home sales. So let's ask what that means in terms of the market tendencies. And after Friday's new high for the now lead contract September S&P, didn't quite get above the old premium price lead contract high for the June contract that just expired last Thursday into Friday morning at 1959.50, but it did push up to a new high in the contract up at 1955.5 and pulled back and kept the bid after a modest gap higher opening from Thursday's close in the 1950 area. And one of the things we note is that the hourly MACD a bit later on in the day on Friday finally gave up the upper runaway band and slipped back below it, and this could be a sign the market is getting a bit tired. It wouldn't preclude it running up to some higher resistances we'll explore on the intermediate term view in about the 1967 area, but it does show that the heat that was in the market from the time it responded so well by overrunning 1938, that had been the old lead contract runaway gap objective in the June contract, coming back in from the Memorial Day weekend on that Tuesday when it gapped the 1900 area, that old objective the market had pushed above, tried to exceed it, pulled back below it as the FOMC statement and projections came out, and throughout Janet Yellen's sharing her still accommodative view, which we had felt was going to be the case, the pushback above 38 was not only reasserting itself back above that upside objective, it was also accelerating out of its near-term upward channel since the correction low back at 1920. And that was, of course, the equivalent of the 1925 trading low in the lead contract. So we'll be keeping an eye up on the mid to upper 1960s. But there's lots of support below this market initially at this aggressive upward channel since that last reaction low. That gets up into the mid to upper 1940s. That's also an important Fibonacci retracement on any initial pullback. And that about does it for the short-term view of the S&P 500. Moving over to the intermediate term view, you can see the runaway gap going back to the end of May, and this set up that objective, as we said, at 1938, that the lead contract exceeded and reacted back below and then was able to push back above. That's generally a constructive sign, and again, leaves that as support. If you look at the broader support on the September contract, even if it should react all the way back down on some type of sharp several day to 1 week correction, it's got good support back in toward that 1917-18 area we had highlighted previous, and of course the upward channel that moves up into that area to somewhat above it over the course of the next few days into later this week. The resistance, though, remains this major upward channel return line. This is the major upward channel off the lows in 2011 and the pullback lows back after the election in November of 2012. And so you can see how the market has neared or tested this line on multiple occasions, and for the last several weeks or so, it has actually pushed up right near it, and this week it, as we said, is up around the 1967 area or so. Much above that, this market would be accelerating up out of a major channel. We'd give that a berth of about $5, so anything much above 72 would be very important this week. Now, that's also important because if you add 135, 130 to 135 is the next oscillator resistance. Now, if the market's been out above 110 again, you're looking at 1860 as the oscillator resistance, and that just makes any escape of the topping line up at 1867 that much more impressive, with clear indications there that the market is probably ready to go up toward 2000 if it escapes. And that's pretty much it for the intermediate term view on the S&P.